How the hell are you doing, guys? I want to show you guys a real life example of how dividends work and try to explain it in a different manner other than what other, sorry, a different way than people and other channels have explained to you before. I don't want to give you the pen and paper exercise where I walk you through and try to explain it in very simple details. What I want to show you is a real life example from full year 2016 financial results of Exxon, utilizing their investor presentation, and get you guys an idea as how to read something like this from different companies throughout the entire public industry, whether it is from IBM, Exxon, Aqua America, or whatever company that you invest in. You'd be able to read this and say, okay, how does it look? What's the payout comparison compared to what I'm actually invested in? So let's just jump right into it. So for the full year 2016 results for Exxon, they pulled in about $7.8 billion, which equates to an earnings per share of approximately $1.88. And so what that means is essentially made $7.8 billion, and if you were to essentially divide 7.8 divided by 1.88, you'd get to approximately 4.15 billion shares. And so what that basically is saying is, if you own one share of Exxon-Mobil, your portion of the company's earnings would be $1.88 because you own 4 billionth of the company. And so you'd basically be entitled to a portion of what that company essentially makes in those earnings if they pay out a dividend. And that's exactly what Exxon does. And so looking further into the company and as a whole, you'd say, okay, $1.88 per share of earnings, and as a whole, the company distributed $12.5 billion of total money to shareholders through dividends. As a company as a whole, they spent $19.3 billion of capital expenditures, whether that was for investing in pipelines or drilling rigs or drilling wells to make further investments so they could get more earnings, whatever that was, they spent $19.3 billion on it. And so what does that get you? So that gets you cash flow from operations and then also asset sales, so they could try to make up the deficit between what they paid out and what the earnings per share are, so they can kind of break even. And then they also had $3.7 billion in total cash that they acquired for this year, and they ended up with $42.8 billion in total total debt for the year. And so what does that mean? So if you look at it in terms of sources and uses of cash, you would see, okay, well, Exxon came into the year with about $3.7 billion in cash, which is what it was when they ended 2016 as well. Throughout the year, they earned $7.8 billion. They depreciated $22 billion or so, and that depreciation comes from being able to write off spending and also depletion costs of producing assets in the Gulf of Mexico or Guyana or anywhere else Exxon really works. Working capital to essentially continue to work and do other things. And then essentially they sold off $4.3 billion in total assets. And then so if you combine all these things are positive towards cash, except for this working capital bit. They had to spend $8 billion somewhere. But they earned $7.8 billion. They depreciated $22.3 billion, which goes towards your cash. And then they also had asset sales, which made them $44.3 billion. So this total equals up to $26.4 billion. They had $3.7 billion. So that gets you to around $30 billion if you needed it. Then you start taking away items like your shareholder distributions. That's your dividends. And then you have your capital expenditures for the year, which essentially you're paying for additional things to invest in or that you're never going to get money back for, like putting in pipelines into the ground and whatnot. And then you have additional things like financing and debt so that they can make sure that they still have enough money to continue to have on hand for short-term emergencies or whatnot. So basically you have 3.7, your 26.4, so that gets you to around your 30 billion. And then you have your shareholder distributions and capital expenditures that you see here. So then you look at it in a graphic form, right? So sources of cash is on your left and uses of cash is on your right. And this goes from 0 to approximately 30 billion. And what you'll see, cash flow from operations, that's at 22.1 from the previous slide. Then you have your asset sales, Exxon selling things off to try to make sure that they meet the total deficit. And then debt and other financing, that's that $2.8 billion that they raised in financing. And so what you're seeing is $12.5 billion in total distributions from the company, and you're seeing the remainder of your capital expenditures. So the reason why Exxon went out and raised debt and other financing of $2.8 billion is because essentially you're looking for your sources of cash to be greater than, and hopefully much, much greater than, your uses of cash. You would see without this debt and other financing, your uses of cash would be much more than your sources of cash, and otherwise Exxon would have had to dig into their available cash piles or sold additional stock in order to attain this amount of money to make sure that they broke even with respect to their sources and uses of cash. So with that being said, Exxon currently is in a very tough oil environment. Oil dropped down, as we're all aware, approximately 50%, even more so, back in 2014 to now. And currently we're still approximately half of what it was back in the day. So what this is actually showing is Exxon really, was able to meet the majority of their capital uses that they had, but they had to sell some stuff and they had to also manage some debt financing in order to make sure that they didn't, use too much of a cash pile in order to attain it. But another thing that it's showing is basically, if you're looking at just in terms of free cash flow, you're basically taking all this on the left and basically just your total capital expenditures and whatnot. You end up with $9.7 billion, which in normal terms for a company is phenomenal, right? $9.7 billion to do with whatever you want is phenomenal, but what you can also see is that $9.7 billion does not entirely cover your $12.5 billion of total shareholder distributions. So in terms of longevity, being able to maintain this $12.5 billion of total dividend distribution is kind of saying that it's at risk, right? I mean, you're still lacking about $3 billion of free cash flow to positively distribute to your shareholders without any sort of worry or concern or without having to go and sell more assets and raise more debt. So that's something to keep in mind. That's, a lot of people always look at something called a payout ratio. So if you were to look at a payout ratio, you would say, okay, well, what are the uses of cash compared to earnings or this or that? That's great, but at the end of the day, that might be a really quick way to really analyze how a company's doing. But what you really need to look at is how is the company getting their cash, right? I mean, you really have to look at the payout ratio compared to the free cash flow, or the payout ratio compared to the total cash from operations, or basically just looking at absolutely everything to make sure that your distributions are safe. Because it could very well be that Exxon didn't change their capital expenditures for the year and still had it at the $30 to $40 billion that it was, back in 2013, 2014, and they still would be not able to cover anything like this. This right, sources of uses of cash, this PP&E and ads and investments and advancements, that would have been closer to getting this line up to the 40 or even $50 billion range. And at the current price environment, your cash flow from operations wouldn't be able to support that. So that's just something to really keep in mind is what's your free cash flow? Because at the end of the day, that's literally just taking all the things that are coming through your door, your your actual earnings, your actual cash flow, your actual asset sales, what kind of debt you raised, whether it was good debt, bad debt, doesn't matter. But then it takes away your capital expenditures and shows you, okay, they have $9.7 billion to do whatever, buy back shares, distribute the dividend, what have you. And if that free cash flow isn't able to meet your shareholder distributions, you might not necessarily want to invest in that company right now unless they have a good plan to, or at least a line of sight as to how they're going to start balancing out their sources and uses of cash. In terms of Exxon, they're continuing to go through capital improvements and getting rid of some of the excess CAPEX that they're showing throughout the year. And also they're getting into a better price environment with oil and gas prices. So hopefully that was useful to you guys. I know I kind of went on a rant, but I'm hoping that that was a more useful scenario of looking at dividends and payouts, and instead of just looking at it as a paper exercise and saying, okay, earnings versus what your shareholder distribution would be. Because if you were to look at that, right, they only had 7-point-something billion dollars of total earnings, and they distributed more than that. So if you were to say, okay, well, boom, I'm going to stay away from that. There's no way they're paying out almost twice as much in dividends as they're earning. It's like, yes, but you kind of have to look at it more in depth than that, right? I mean, and if you were to look at the same thing for like a real estate investment trust, you would say, okay, well, there's no way I would ever invest in a real estate investment trust because they're paying out way more than they're making in earnings per share. But in all reality, you need to realize that when you invest in a real estate investment trust, you need to look at their funds from operations, which is similar to the cash flow from operations that you see from Exxon. You need to say, okay, well, based off of how the taxes and the capital distribution from real estate investment trusts work, you really need to look at the shareholder distributions compared to the funds from operations. So if this were a real estate investment trust, you would kind of get rid of this PP&E and this asset sale. Well, you'd still have the asset sales, and then you'd still have some debt in organization, but you'd really just be looking at shareholder distributions compared to this, right? Because generally speaking, any capital expenditures, they would just issue more debt. But that's another topic for a different day. I really hope that this was helpful for you guys. Feel free to stop by and ask questions on the channel. And always remember to subscribe and like if you have an opportunity, and if you haven't yet. And please leave comments down below of what other comment or other topics you guys would like me to discuss. And I'll talk to you guys soon. Have a great night.